In my years as a fractional CFO, there are very few businesses I've ever run into that haven't had cash troubles from one time to another. And all the time that I've been a fractional CFO, there are very few businesses I've run into that have never had any cash problems. In the life cycle of a business, cash flow will go up and it'll go down. And, there are very few of us who've completely escaped the cash problem. So I wanted to bring to you today a few cash flow tips. These are going to be indicators of when you might have a cash flow problem in the future, because ideally we want to catch potential cash flow issues way before they actually become a problem, okay? So if you are a service-based business owner, and particularly if you work in B2B services where maybe you are invoicing services for somebody else, if you have billable time, or if you are charging for hours, or potentially that you have staff that you are billing for services to some other type of business, that is specifically who this video is for, because some of these metrics are going to be more helpful to those types of businesses versus others, okay? So that is what I want to cover today in today's video. And who am I? In case you're wondering, my name is Hannah Smolinski. I am the founder of Claire CFO Group, and we focus specifically on serving service-based businesses and with our fractional CFO services and businesses that are between $2 and $20 million in annual revenue. So we see larger businesses have cash flow problems, just like businesses that are starting up and growing. That's what we want to help you with. And these tips I'm telling you today can help even if you are not even at that $2 million level yet. Okay, so if cash flow has ever been a concern for you, make sure that you are subscribed to the channel, because we have a lot of cash flow videos, and I am here to help support you in your business and help you become more financially successful. All right, so metric number one I want to bring up to you is something called days sales outstanding. This is an accounting ratio that can be calculated pretty quickly. I'm going to pull up the actual calculation. We're going to walk through an example real quick. But what this metric tells us is it tells us of the total sales that you have where you've extended credit to your customers, how much of that is collectible in a certain period of time, okay? And this gives us a sense of and what would be good for businesses for cash flow purposes is to have a lower number in days sales outstanding. You don't want to have a high number, basically over 30 days or whatever your usual payment terms are. That would be an indicator that money is coming back to you slowly, okay? So we want to have a low number in days sales outstanding. So if you're tracking this metric over time and you start to see it creeping up, this is an indicator and a little flag that says, hey, we might have a cash flow concern in the near future if this number keeps going up. Okay, so I'm going to show you this, and I think it's going to make a little bit more sense. So I'm going to share my screen here. All right, so days sales outstanding. Days sales outstanding equals total average accounts receivable over total credit sales. So where you've actually billed and the money has to come to you later. And then you calculate that number, and then you multiply that times the number of days in the period. So if you were running this for a full year, for example, you would take your accounts receivable balance at the end of the year, and then you would take your total credit sales during the year, and then you would multiply that, and then you would make that division calculation, and then you would multiply that by the number of days in the period. When it says total credit sales here, don't get too wrapped up about that. Most of us, if we are billing for services, almost all of our income is going to be credit sales. Now, if you might have some billable services like that, but then maybe you also sell products, for example, and you're selling it more e-commerce style where it's very much like somebody swiping a credit card and you're getting the money right away, you can exclude those sales. But if you are invoicing customers and there's some kind of invoice process and they have to pay you and there's any lag there, that would be considered a credit sale. Okay, so don't overthink this too much. If you're a service-based business and this is the type of, you always send invoices, then it probably just is your total revenue. Okay, sales equals revenue. All right, so let's get the example here. So the example here is that we're looking at a full year of days sales outstanding calculation, and the accounts receivable balance was $200,000. We found that on the balance sheet. And then the total sales for the year were $1 million. And then when we calculate that, that's going to be 0.2. And then we're going to multiply that times 365 days. okay? And that is going to yield for us the calculation of what is the day sales outstanding. It's 73 days. Okay, so if I was helping this company and as a fractional CFO, I would say, hey, that is a problem. We have way too many days in sales outstanding, especially if I was talking to them in their typical invoice terms or net 30. They're not collecting in net 30. So we should see that average accounts receivable come down. So maybe this is like one outlier invoice that's maybe potentially becoming uncollectible and we just need to write it off. Or maybe this is cyclical and we're just not actually following up to receive on our accounts receivable. So there's lots of things you can do to sort of speed up your accounts receivable. I've done videos on that before, so I'll try to make sure to link those for you. But we need to accelerate accounts receivable, okay, to lower that day sales outstanding, because the longer you have day sales outstanding, the longer you're not getting your cash. And that's why this is an indicator that you might have a cash flow problem in the future, okay? We want a lower amount of day sales outstanding. So this is a great KPI for you to track if you're starting to notice that cash is coming in a little slower, or that customers are just slower to pay, or you're starting to have issues and you're not totally sure why. Calculate your day sales outstanding and then start tracking it. So it might make sense to start tracking it by month, and then you could look at it by quarter and definitely by year. But you want to kind of start to get a sense of like what's average for you, and then you can have an indicator of like, is it getting worse or is it getting better? Okay. So the second metric I want to bring up to you guys is net cash burn, or operating cash flow. Okay. So this is going to be every single month. Are you bringing more money in, or are you spending more money? Are you in a cash flow positive situation, or are you in a cash flow negative situation? Now, so this might seem really obvious to you. Obviously, if you're burning more cash and you're going into a negative every single month, that means that your cash is going down. That is a problem. But when people go to review their financial statements, they're often just looking at their profit and loss, and they might be looking at their balance sheet. And they might not necessarily pull something like a statement of cash flows that will show a net cash change. Okay, because a lot of people don't understand the statement of cash flows, although I have done a video on that and you probably want to go watch it if you don't understand it. Because the profit and loss might potentially show a profit, but all the other things that are happening on the balance sheet, like maybe there's a big owner's draw, maybe there's been a big tax payment, maybe there's been a big debt payment, all of those things affect cash flow, and you actually might be going into the negative. So I see this all the time, that business owners think that they're doing okay from a cash flow perspective because they're profitable. But then when you actually look at their cash flow, they are burning into their cash reserves every single month. So the metric that you need to track is your net operating cash flow. And if you're starting to see that be negative month over month, and you're not having positive months to offset that negative, that's a big indicator that you're going to have cash flow issues. That's a big indicator that you're going to have a cash crunch in the future. And the last thing I want to mention to you all, the third metric, is employee utilization rates. So what is a utilization rate? It basically is the percentage of time an employee spends on billable work compared to the total hours they are working. So a lot of consulting companies of all sorts are going to use something like a billable rate. You know, architecture firms will use this, engineers will use this, consulting firms, marketing firms. There's going to be lots of different types of service-based businesses that are going to use a utilization rate, and they're going to be tracking a utilization rate. So what that's going to be is the billable hours during a period, usually in a week or in a month, divided by the total available hours in a week or a month, and then multiply that times 100. So let's say that you have 40 billable hours in a week, but an employee used 30 hours for actual billable work. So 30 divided by 40 times 100 is going to be 75%. So it's 0.75 times 100 is going to be 75%. Okay, so that is a very important indicator, because if you're tracking utilization rate, and typically what that would be is like you do billable hours, you do the work, and then you can bill the client. So when you are doing that, if you see utilization rates starting to drop, then that's going to be an indicator that your future billings are going to be lower, which means you're going to have less revenue once those bills are paid. Okay. So we really need to be tracking utilization rates if you are a service-based business and you are billing your customers for time. Okay, this is going to be one of the best indicators, because if you really think about it, let's just say that work was being done in January and then you bill for that work at the end of January, beginning of February, but then maybe it's a net 30 on that invoice, and let's just say somebody pays in 45 days instead of 30 days. So then you would be at the middle of March before you start to recognize that the cash is lower than maybe what you thought it should be. So if you're starting to see in January utilization rates going down, you're not going to actually get the cash effect of that until potentially 2 to 2.5 months later. So when you need to track utilization rates, because those are going to be a big indicator for you as a service-based business that's going to be tracking billable hours, it's going to be a big indicator on whether or not you're going to have a future cash crunch. All right. So make sure you're tracking those employee utilization rates. I do like to see them on a weekly basis, get those reports coming in on a weekly basis, so that if you're really having an issue and like you're seeing utilization rates being really low, or maybe one employee's utilization rate is really high and one employee's utilization rate is really low, maybe you can shuffle some work around, spread the work out. Nobody gets overworked, overburdened, and everybody's at a healthier utilization rate. Okay. So ideally you're tracking utilization rates on a weekly basis. So those are the 3 metrics I have for you that are going to be indicators of a potential future cash crunch. Let's go over those real quick, just one more time. Days sales outstanding, your net operating cash flow, and then your employee utilization rate. If you're keeping an eye on these things, you're going to be able to get flags way ahead of time so you can start to take action so you don't run into a cash crisis. All right, well, if this video was helpful, please give it a thumbs up and share it with another business owner friend that you think might also enjoy it. And I will see you in the next video.